Welcome back to the Deep Dive. Today, well, we're strapping in for something pretty interesting.
Oh, yeah.
We're looking at the intersection of failure and opportunity. We're digging into some S&P 500 stocks that have, frankly, fallen hard, like 33% or more year to date.
Ouch.
But they're still generating some impressive income. So let me ask you, how does a, say, 7.8% dividend yield sound right now?
Well, it sounds like either a ringing alarm bell,
Right.
or maybe, just maybe, a massive bargain. And that tension, that's exactly why we're here today.
Okay.
Our mission, really, is to cut through the noise on this. We need to understand the mechanics behind it. How does a reliable dividend turn into a high yield when the stock just collapses?
Right.
And then we need to really examine three specific companies, see if their current struggles are, a long-term opportunity for you, the patient income investor.
Or just a trap.
Or just a dangerous value trap. Exactly.
Okay, let's lay the groundwork first. We're
Right.
talking about generally healthy dividend-paying stocks here.
That's the key starting point.
These are companies that tend to reward shareholders pretty regularly, right? Often increasing those payouts each year, kind of regardless of what the broader economy is doing. That consistency, it's crucial.
Absolutely crucial. That consistency, that's the numerator in the little equation we're about to get into.
Oh, the math part.
Yeah, when a company is reliable like that, the math of the dividend yield becomes almost, well, brutally simple.
Okay, this is important, especially for anyone learning. Let's really ground this formula. Yield equals the annual payout divided by the current share price. Simple enough. Let's run some numbers.
Okay, so imagine a company, just hypothetically, pays out $4 per share every year consistently.
Right, $4 payout.
If that stock's doing well, trading strongly at, say, $80 a share, you've got a solid 5% yield.
Okay, 5%, nothing crazy, but stable income.
Stable, exactly. But, and here's where the market panic creates the potential opportunity.
Okay.
If the market suddenly decides that company's in trouble, maybe a bad quarter or something, and the stock price tanks down to $60, let's say.
Okay, down to $60.
But, and this is the important part, management keeps that commitment. They still pay out the same $4.
So the payout stays the same even though the price dropped?
Exactly. Now the dynamics change completely.
Okay, so what's the yield now?
Well, $4 divided by $60, that instantly gives you a 6.7% yield.
Wow, okay.
And the company didn't have to lift a finger, didn't have to raise the dividend itself. The market's pessimism, it literally creates that opportunity for higher passive income.
That's the dynamic.
That is the dynamic we're exploring today. And we're focusing specifically on three giants, S&P 500 companies that have sunk, like you said, to 33% or more just this year.
All right, let's dive into the first one. A name everyone knows, I think. Its fortunes are definitely tied to how consumers are feeling. United Parcel Service, UPS.
Right, UPS. Their stock is down about, 33% year to date. And that really dramatic decline has pushed its recent dividend yield up to a whopping 7.82%.
7.82%, that is.
Yeah.
That's really high for a company like UPS.
It's extremely high for a company of that size and, frankly, historical stability.
Okay, before we get into the why behind the drop, let's just ground this for you listening. What does a 7.8% yield actually mean, like in real-world terms, for a typical income investment?
It means significant income generation potential. I mean, to put that 7.82% into context, if you were to invest maybe $5,000 in UPS right now at this lower price,
If you have $5,000.
you could reasonably expect around $390 in passive annual income, just from the dividend checks.
$390 a year on a $5,000 investment. Okay, so why the huge drop then? Is the shipping business suddenly, obsolete?
No, not obsolete, but it's definitely facing some significant pressure from two angles, really.
Okay, what are they?
Well, the first is just broad economic uncertainty. Rising interest rates, inflation hitting people's wallets, maybe some lingering job worries.
So people are buying less stuff online?
Basically, yeah. Online shopping volume just isn't growing at that, breakneck pace it was during and right after the pandemic doom. Less shipping volume means lower revenue projections for UPS.
Makes sense. And the second issue, you said there were two. Sounds like this one is maybe a bit self-inflicted, but strategic.
Yeah, that's a good way to put it. They're shrinking their business with a former major client who's now, a major competitor.
You mean Amazon?
Precisely. UPS has been actively, and you could argue necessarily, reducing its reliance on Amazon.com. Amazon, of course, has spent years building out its own massive delivery network.
Right.
So while pulling back from one huge customer might be healthy for UPS long-term, less concentration risk,
Sure.
it causes a very measurable, pretty painful hit to revenue in the short term. And investors see that, and they tend to flee.
Okay, but hold on. You mentioned the forward PE ratio earlier, the price to earnings. Isn't that huge gap we're seeing just the market correctly pricing in the risk? Like UPS lost the Amazon business, maybe permanently, earnings are struggling. Why isn't this just a classic value trap?
That is absolutely the critical question here. And yeah, this is where we need to understand that valuation metric, the forward PE ratio. It tells you how much investors are willing to pay today for every dollar of the company's expected future earnings.
Right, forward looking at expected earnings, usually over the next year or so.
Correct. So UPS's recent forward PE is sitting around 11.3. Now you compare that to its 5-year historical average PE, which is about 15.8.
Okay, 11.3 versus 15.8, that's a big difference.
It's a huge gap, and that gap represents the market expressing some deep skepticism right now.
They're basically saying future earnings are going to be much worse.
Yeah, the market's projecting significantly worse future earnings, which, in their view, justifies the stock price collapse.
Yeah.
And it also suggests, there's a higher probability they might have to cut that juicy dividend eventually.
Okay, so the flip side is if UPS management can navigate this, this short-term dip, if they don't cut the dividend, and maybe e-commerce growth just kind of normalizes,
Right.
couldn't that stock pretty easily re-rate back towards that 15.8 historical average?
Absolutely. That difference, that gap between 11.3 and 15.8, that represents the market discount you're getting today. It's the reward for being a long-term believer.
A believer that e-commerce isn't dead and that UPS can figure out its strategy after relying so much on Amazon.
Exactly. It's a bet on management and the underlying stability of shipping demand, essentially.
Okay, interesting. So we saw how global economic uncertainty hit UPS, a key supply chain player. Now let's look at Target. They faced kind of a different mix of issues, right? Lingering operational stuff plus some specific sort of internal PR challenges.
Yeah, Target. I mean, it's a massive operation. Everyone knows Target. Nearly 2,000 stores across the U.S., pulling in over $107 billion in net sales recently.
Huge company. Yet their stock is currently down about, 35% year to date?
Around 35%, yeah. Pretty significant drop.
And that plunge pushed their dividend yield up to 5.12%. But you mentioned earlier, sometimes companies return cash in other ways.
Right, like share repurchases. If you factor those in for Target, their total return to shareholders was actually closer to 8% recently, around 8.02%.
Okay, that's substantial. And I saw something interesting. Their dividend has actually grown by an average of 8.8% per year over the last decade through all the chaos of retail.
That's right, an 8.8% average annual growth rate. That suggests management is highly, highly committed to returning cash to shareholders.
Yeah, it really does. Which makes you ask, why the sharp drop this year if that underlying commitment seems so strong?
That's the puzzle. The sources we looked at point to a couple of key reasons. One is sort of a hangover from previous years. They're still absorbing the costs and complexities from those major supply chain disruptions.
Ah, right. Still hitting their profit margins.
Exactly. And then there was the other major factor, which got a lot of media attention. It was an internal corporate decision about certain social commitments.
Okay, I remember this.
Yeah, the sources note that their shift away from certain diversity, equity, and inclusion, or DEI policies, created some, significant public relations friction.
And that actually hurt sales.
Apparently so. It led directly to measurable declines in store foot traffic and sales in some markets, especially back in Q2.
Wow. That's a really clear example of how, non-financial decisions can hit the bottom line and investor sentiment almost immediately.
Precisely. So, as an investor looking at this, you have to evaluate. Is that hit to sales and reputation permanent? Or is it temporary?
And the valuation might give us a clue there.
Again, looking at the valuation, the numbers seem to support the idea of a temporary dip, or at least that the market is pricing it as potentially temporary if you're optimistic.
How so? Let's see the PE numbers.
Okay, Target's recent forward PE ratio is sitting at 11.8.
11.8. And it's average.
Its 5-year average is 16.2.
Okay, another significant gap.
Yeah.
11.8 versus 16.2.
Right, so if you believe the operational issues, the supply chain stuff are fixable, and maybe the consumer and PR friction will eventually fade.
Then that difference is your buffer.
Exactly. That difference provides you with a significant margin of safety. You're essentially buying a very reliable dividend payer based on that growth history at a steep discount to its historical norm.
Okay, margin of safety. Got it. Let's move to our third company.
Mm-hmm.
This one's seen the steepest drop of the three we're looking at.
Yeah, this one's pretty dramatic.
So if UPS and Target's issues were largely economic or maybe self-inflicted, Constellation Brands seems to show how really deep societal shifts can instantly re-rate a stock.
That's right. Constellation Brands, ticker STZ, it's down a shocking 40% year to date, just plummeted.
40%, wow. Okay, and the yield?
Well, that drop pushed its dividend yield up to 3.06%. Now, that's lower than UPS or Target's dividend yield.
Right, only about 3%.
But again, factor in the recent, very substantial share buybacks, and the total shareholder return gets much closer to 8%. Similar ballpark to Target, actually.
Okay, 8% total return. And for those maybe not familiar, Constellation Brands is all about alcoholic beverages, right?
Yeah.
Big names like Corona, Modelo, Robert Mondavi wines.
Exactly. Beer, wine, spirits, mainly operating across the U.S., Mexico, New Zealand, Italy, key markets.
So why the collapse? They sell popular stuff. Corona and Modelo are huge.
Yeah, it's fascinating here because it seems like behavioral factors, even geopolitical ones, are hitting this stock hard and fast.
Like what?
Well, for one, there's verifiable data showing declining drinking rates among younger people in the U.S.
Oh, interesting. Like Gen Z drinking less?
Yeah, that seems to be the trend. And that's a massive, kind of slow-moving societal shift that directly impacts their core business model, especially for beer and maybe some wines.
That's not just a bad quarter. That's a fundamental challenge.
It is. And on top of that, there are reportedly impacts from things like tariffs and immigration-related concerns.
How does that affect beer sales?
Well, the sources suggest these factors are causing shifts in consumer spending habits, particularly leading to maybe decreased spending on beer among certain demographics, specifically Hispanic consumers who are a really key market for Constellation's big Mexican import brands like Modelo and Corona.
Wow. It's kind of wild to think that Corona and Modelo sales are being shaped so directly by, real-world geopolitics and demographic spending shifts.
It really highlights how interconnected everything is. So faced with these big external pressures, how do they plan to recover?
Yeah, what's the strategy?
Their future strategy seems to center on two things. First, shifting focus more towards their higher-end wine and spirits brands. Those tend to have better profit margins than mass-market beer.
Okay, go up market.
Right. And second, combining that with pretty aggressive cost-cutting measures to try and stabilize profits while they make that shift.
And does the current valuation reflect the market's doubt about this strategy? Let's check the PE again.
Yeah, the story is often told right there. Constellation Brands has a recent forward PE ratio of just 11.3.
11.3. Okay, what was its average?
Compare that to its 5-year average PE, which is a massive 18.2.
Whoa, 11.3 versus 18.2. That's an enormous gap.
Huge. The fact that the forward multiple is so far below its history really reflects the magnitude of the market's pessimism right now.
They're basically priced as if the whole business model is fundamentally broken, or at least severely challenged long-term.
Pretty much. You, as an investor buying now, are being compensated heavily for the high risk that those consumer trends, like lower drinking rates, continue. But you're also being compensated for the possibility that their strategic pivot, shifting to higher margin brands, actually works and drives earnings back closer to historical levels eventually.
Exactly right. You really have to be confident that management can adapt quickly to these changing tastes and these geopolitical shifts to realize that financial value. It's a bigger bet, perhaps.
Okay, so that really seems to be the common thread here. Across all three companies we've looked at today,
Yeah.
a significant stock price dip, right? 33% or more, leading to these unusually high dividend yields, or at least high total shareholder yields.
Mm-hmm.
But crucially, they're all trading well below their historical average valuations. That's shown pretty clearly by those forward PE ratios being so much lower than their 5-year averages.
Yeah, the discount is quantifiable.
So I guess we have to remember, being a long-term believer, being a patient investor, that seems absolutely paramount in these kinds of turnaround situations, because essentially you are being paid to wait. Precisely. You're getting that higher income stream, that higher yield, specifically to compensate you for the risk. The risk that maybe the company won't turn around, or maybe they will eventually have to cut that dividend.
Right.
The potential payoff, though, is that, reversion to the mean. That moment when the market decides the crisis is over, or the strategy is working, and the stock price jumps back up towards its historical PE ratio. Plus, you collected the dividends along the way.
Yeah, the double win potential.
Mhm.
But this investigation, these three examples, it's obviously not exhaustive.
Not at all.
The source material we looked at made a point of reminding us, there are countless other strong dividend payers out there. And maybe an even simpler way to participate in this kind of strategy, but without taking on so much specific company risk.
Yeah, that's a really important point. We should definitely remember that these single stock examples, they carry inherent risks. I mean, a surprise dividend cut by UPS or Target would be pretty devastating to this specific income strategy if you were solely invested in one of them.
Right. Concentration risk again.
Exactly. So, if you, the listener, are curious about generating income like this, but maybe want to diversify that risk away, your next step could be to look into some excellent dividend-focused exchange-traded funds, ETFs.
Dividend ETFs. Good idea.
Yeah, these funds, they spread your investment and therefore the risk across dozens, sometimes hundreds, of consistent dividend-paying companies. They offer stability even if one or two companies within the fund falter.
So the opportunity in dividend investing is often found where others have panicked.
Mm-hmm.
But maybe remember that panic often carries a reason, or at least perceived reason.
Well said. Do your homework.
Now maybe go explore how diversification through something like an ETS can make that income stream potentially safer for the long haul.